Now that inflation is starting to rear its ugly head again in developed economies, I thought I would share some thoughts. So, how and why does inflation happen? Who are its winners and losers? What does it mean for the way we live and for our investments? And how should we react to it? These are not easy questions. Inflation tends to occur unevenly throughout the economy. That is, it affects different things differently. And there can be significant time lags between cause and effect. This makes it difficult to figure out what will happen and when. Even though inflation eventually raises the price of everything, including how much money people make, the income side of the ledger tends to lag the expenditure side during inflationary periods. For example, in the US in the 1970s, we had a period of sustained double-digit inflation, accompanied by sluggish economic growth. We called it stagflation. There was even something called the misery index, which combined the inflation and unemployment rates. But not everyone was miserable. I, for instance, was having a grand time. I worked my way through university as a part-time waiter and bartender, and my tips quickly reflected the looser monetary conditions. My big expenses, like tuition, were fixed and didn't go up at all. I was still maybe 6 or 7 years away from landing my first real job, and so had plenty of time for wages to catch up with the general price level. So there are some winners as well as losers from inflation. Winners are people with assets that benefit, such as real estate and some stocks. And they include people with large debts, like mortgages or student loans, because they will eventually pay off those debts with depreciated dollars and pounds. But typically, there are more losers than winners. The reason is that the effects of inflation are arbitrary. I didn't deserve to benefit because I happened to have a large student loan. I was just lucky. In a healthy economy, that's not how things are supposed to work. Benefits should accrue to people and companies that do the best job of creating value for the economy as a whole. In this way, economic growth is maximized and living standards increase. Also, if inflationary expectations become entrenched, behavior begins to reflect that fact. For example, by taking on more debt or acquiring more assets than is prudent. After a while, we end up with a period of substandard growth, just like the US in the 1970s. We've mentioned inflation's impact on some asset classes. It's usually good for real assets, such as real estate and commodities, and bad for bonds. Stocks are more of a mixed bag. Theoretically, because stocks represent ownership in productive assets like factories and intellectual property, inflation should be good, but that has not always been the case. For example, the dreaded 1970s in many markets were a terrible time for stocks. It's also true that not all companies are created equal. Those with pricing power and less exposure to input pricing pressures, usually companies with higher gross margins, should do well. But companies that can't raise their product prices fast enough to compensate for rising cost pressures can be decimated. In addition, higher inflation correlates with higher interest rates and higher discount rates, so it is not good for high-growth companies, such as technology, all else being equal. In the short run, whether we are in for a period of high inflation or even stagflation, it's up in the air. But to paraphrase the old Chinese saying, we certainly do live in interesting times.